Welcome to the deep dive. We're plunging into the sources you've provided, pulling out those crucial insights. Today, we're stepping back quite a way, actually. We're looking at Markel Group's 1996 annual report, Our Mission, to really understand the philosophy, the strategy from that specific year, 1996. It seems like a time they were nailing down the foundations for their long-term vision. You've given us some great material here, so let's explore how they built that legacy.
It really is fascinating, isn't it? Going back to the original source like this,
Yeah.
especially with Markel, looking at a report from, nearly 30 years ago. It's not just history. You find these foundational principles that are just, timeless. And the clarity, the foresight in these old documents, it's kind of surprising, really.
Yeah.
It speaks volumes.
Absolutely. So, okay, let's unpack this then. 1996 sounds like a key year. They were dealing with challenges, sure, but also reinforcing their base. When you first looked at this 96 report, what sort of jumped out at you? What was the first impression?
Well, the immediate thing is this feeling of consistent achievement, real focus on the long term, which is pretty impressive when you think about the specific problems they actually faced that year.
Yeah.
I mean, despite those hurdles, their main goal for the year, making an underwriting profit, they did it. They ended 96 with a combined ratio just slightly under 100%.
Right, and that combined ratio, just under 100, that's a big deal. For anyone maybe less familiar, it basically means for every premium dollar coming in, just under a dollar went out for claims and costs. That signals a healthy insurance operation, fundamentally profitable. And like you said, it wasn't easy. The report mentions storm losses, Hurricane Fran, hitting some product lines hard, yet they point to the extraordinary underwriting success of Essex Insurance Company. That was critical, wasn't it?
Oh, absolutely critical. It wasn't just smooth sailing. They really had to perform. And this kind of resilience, it wasn't just a one-off thing for 96. If you look at the decade leading up to it, Markel showed really consistent success. Total operating revenues grew, 31% compound annual growth rate over those 10 years. Impressive. And the investment portfolio, even more striking, 44% compound rate up to $1.1 billion. And that key metric, book value per share, the company's net worth per share, hit $49.16. That's a 31% compound increase over 10 years, too.
Wow. And the 96 numbers themselves really back that story up. Operating revenues up 7% to $366.7 million. Core underwriting and investing results, $33.9 million. That was up 17% from 95. And get this, net income was a company record, $46.7 million, or $8.30 a share. Plus, shareholders' equity per share jumped 25% to that $49.16, your real value creation there.
Exactly. And what's really compelling, I think, is how they did it. Hitting these strong numbers while dealing with significant headwinds like those storm losses. It's not just growth for growth's sake. It's profitable growth built on deep operational strength and clear strategy. That doesn't just happen. It comes from principles they really stick to.
Right, that operational strength, that ability to handle the storms, it seems to tie back to what they call their bedrock principle, the margin of safety. And it's not just a phrase. They explicitly credit Ben Graham. What's the significance of seeing Graham's ideas applied so directly like that?
Well, it's incredibly significant. Ben Graham, he's the founding father of modern security analysis, right? His principles gave Markel this solid framework for investing, for decision-making in general. But what's really interesting is they didn't just use his ideas for picking stocks. They took that core concept, margin of safety, and sort of wove it into everything they did. Business operations, too. So their main investment concept, as they put it in 96, is operating with this margin of safety. It's not about avoiding risk altogether. It's about building a safety net, a cushion, into every decision, business or investment, to handle errors, absorb shocks, deal with bad outcomes. How? Well, acting on facts, not emotion, using conservative forecasts, diversifying risk. They saw it as a powerful business tool, a strategy, not just finance. It allowed them to be, not just resilient, maybe even anti-fragile, able to benefit from the unexpected, not just survive it.
That's a really key point. Anti-fragile, not just resilient. It's about building in that buffer, that wiggle room. Whether you're investing, planning a project, running a business, that cushion lets you absorb the hits and maybe even get stronger. So for you listening, it's maybe about asking, where's my buffer? Am I leaving enough room for error?
Exactly. And this idea, this margin of safety thinking, it flows right into their accounting philosophy. Financial strength is just paramount for them, full stop. They believe clients deserve the absolute greatest security, and shareholders, they deserve to see that book value per share grow steadily long term.
And they really walk the talk. There are some concrete examples in the report, like the Shan Evanston acquisition back in 1990. There was a non-compete agreement. Instead of spreading that cost over, say, 40 years as goodwill, which can make the balance sheet look bigger, short-term planner. They amortized it over just 4 years, much more conservative. Yeah, meant a charge against earnings, about $5 million a year, even with a tax benefit. But the result, a stronger, more conservatively stated balance sheet. A deliberate choice.
It's a really striking example, isn't it? So many companies might stretch that out to flatter earnings. Markel clearly prioritized actual financial health over just looking good. Another example from '96 itself, they recognized an $18.4 million tax benefit. Now, this wasn't some sudden windfall. It came from tax reserves they'd set up conservatively in prior years. It just turned out to be too high. It really underlines their view that loss reserves are, and I think they said, the most important account for an insurer. They want them rock solid.
And their philosophy on setting those reserves is crystal clear. They aim for reserves that are more likely to prove redundant than deficient, which really contrasted with the wider industry back then. The report mentions Best estimated the P&C industry was under-reserved by what, $82.8 billion? A huge number, like 23% of total reserves. Markel, though, was constantly reviewing, aiming to make sure their reserves were adequate, even more than adequate. They saw it as essential for making an underwriting profit.
Right. And why does this conservatism matter so much, especially in insurance? Because your current loss estimates, they don't just hit the financial statements now. They directly impact your future pricing, your risk selection, everything. So by setting adequate, maybe even redundant reserves, they're building another layer of margin of safety right into the core operations. It's like a feedback loop of prudence.
And they showed proof. The report notes back in December '91, they had $557.6 million in loss reserves. Over the following years, as claims developed, they actually reduced that initial estimate. By '96, they figured about $24.1 million of the prior year's estimate was redundant, about 4% of the original amount. It's not just accounting jargon. It validates their whole approach, maintaining reserves with that safety margin year after year.
Okay, so they built this incredibly solid financial base through conservative accounting. How did they actually, make money day to day? That leads us to their two pillars: underwriting discipline and their investment strategy. In '96, earned premiums were $307.5 million, and they spread that risk across over 40 different product lines. Talked about a history of modest underwriting profits, aiming for that combined ratio just under 100.
Yeah, but even with that discipline, they still face the usual insurance challenges. New products, for example, often cost more initially than you want, ratio-wise. And weather, obviously, like that $1.7 million hit from Hurricane Fran we talked about. But even with those things, their long-term goal, their expectation, was combined ratios down in the low 90s. Shows real commitment to underwriting profit over time.
That is a bold target, yeah, especially with those immediate hits. And it wasn't just a broad goal. They highlighted specific profitable areas. Physicians' medical malpractice was strong. So was general liability, written by Essex, the same unit that helped offset the hurricane losses. And other lines, too, covering contractors, bars, taverns, offices, small products. Quite diverse. So it wasn't just spreading risk. It was real expertise in specific niches.
And then you connect that to their investment strategy, which really complements the underwriting. Their big goal, stated right there, is long-term growth in book value, that net asset value per share. And they're clear. That comes from thoughtful, diligent, safe underwriting profits first. Then on the investment side, the focus is total return, not just chasing yield or current income. They're trying to genuinely build value over the long haul.
And how they allocated the money is interesting, too. Another layer of that margin of safety. Money from policyholders, the funds they might need to pay out relatively soon that gets invested conservatively. High-quality, short-term fixed income, safe, liquid. But the shareholders' capital, their own money, that goes into long-term common stocks. And they're looking to buy companies at or below what they estimate their intrinsic value is. Classic value investing.
It's a really balanced approach when you look at it. On the fixed income side, they're minimizing interest rate risk, credit risk. Very careful. They even used put features back then, which could add return if rates fell. Shows a sophisticated understanding. And the equity portfolio, no undue risk there either. They did extensive research, visited management. That deep due diligence is just another critical part of their safety margin. Know what you own.
So beyond the core underwriting and investing, the '96 report also mentioned some other things happening, strategic moves, like acquiring Investors Insurance Holding Corp. in October '96. Sounds like they found a company with a solid plan, liked the management, and got it at a good price.
Right. It kind of speaks to their acquisition philosophy, doesn't it? It's not just about the numbers, it's disciplined valuation, yes, but also finding good managers, a good cultural fit. And then looking ahead from 96, they mentioned raising $150 million in January 97 on terms they felt were very attractive. It shows they could access capital strategically when the time was right. Confidence in their future.
And the way they raised it was interesting, too. A security that deferred interest payments for 5 years. That provides long-term deferral subordination. It signals real confidence in their ability to create value over time, doesn't it? They weren't worried about immediate interest payments. They were playing the long game with that capital.
Absolutely. And their overall outlook in the report reflected that. They had a good plan for 97, committed to achieve continued success. They acknowledged problems and opportunities would come, but they felt stronger, better prepared. And they were optimistic about the insurance industry's future, expecting it to evolve and reorganize, which it certainly did. It's a very pragmatic outlook, but also hopeful, based on knowing their own strengths.
So putting it all together, you see a company really focused on the horizon, not just the next quarter, but the next decade. With a clear plan for navigating challenges and grabbing opportunities, it really speaks to the power of sticking to your principles. This deep dive into Markel's 1996 report has been really, really insightful. It hammers home those core lessons that feel just as relevant now, that commitment to a margin of safety in everything, conservative accounting for real strength, disciplined underwriting, and that long-term, value-focused investing.
It really does. Those principles from 96, they're not just historical footnotes. They genuinely look like a blueprint for building lasting financial strength, real shareholder value. You can see clearly how those foundations helped them through challenges back then. And honestly, those kinds of timeless principles, they seem even more vital in today's, complex, often volatile world.
It really makes you think. Seeing how Markel operated back then with such clarity, discipline, that long view, it makes you wonder. In our world today, which often feels so fast-paced, so focused on the short term, are we collectively giving enough weight to these old-school principles, patience, prudence, really understanding value, or are we too often just chasing the next quick win, maybe losing sight of building something truly enduring, something for you to reflect on, perhaps how these ideas might apply to your own world, your business, your investments, even personal planning? Thanks so much for bringing these fantastic sources for our deep dive today. It's been a real pleasure unpacking them with you.